Good morning, everybody. Welcome in to Q2 2026 Oscar earnings. We're going to be breaking it all down. Me and my guy AC here for the, I think, third time in a row we're covering Oscar health earnings. Last time was a banger. We obviously went on a massive run up to about a high of $36 since last earnings. Today, we absolutely demolished earnings again. They crushed it on top and bottom line. And yeah, really excited to be a shareholder in this company, honestly. And I'm to the point now where I don't feel like I have to babysit the company. I don't have to sit here and just like constantly be all over every little thing. I'm at the point now where I'm like, I trust management, I trust the direction of this company, and I'm just sitting back and relaxing. How are you feeling, AC? How's your morning going?
It's going great. Everything is looking good on my end, especially on this earnings call. Everything across the board is absolutely crushing it. I mean, from an operational standpoint, their margin was very strong for a Q2, especially considering 2025 and how rough of a year that was. Guidance raised, what is that, 100%, 100% on the low end, and a pretty dramatic increase on the high end as well. On the high end, almost 4% margins is now the guide. And if you haven't already paid attention to Q1, Q1 was very, Q1 was most certainly very conservative. So hopefully we can get some more commentary from management, especially on like risk adjustment, medical loss ratio, and kind of understand more and see if there's some more sandbag to the rest of the year, or if these are the results. And either way, we're still pretty undervalued as well here. So it's going to be a great year.
Awesome. Yeah, I mean, I'll let you go ahead and break down the earnings. Everybody, make sure you go over to X and on YouTube and follow at Investing with AC. He covers Oscar. He covers a lot of other great stocks as well. Me and him have, been covering Oscar together for a little while now, and he does great work, great analysis. So if you're a follower of me, make sure you follow AC as well. But yeah, go ahead, man. I'll let you break down earnings and give us your take, and then I'll kind of chime in afterwards.
Yes. All
And I
right.
got it up
So
on screen too.
yes. So revenue, first off, revenue is 4.88 billion, up 70% year over year. MLR 79.2%, which is a little bit of an increase when you're looking at quarter over quarter, roughly just under 9%. SG&A 14.2%. That is a huge beat across the board, especially last quarter. Looks like I'm having problems with my microphone.
Yeah, I just saw that. Hold on.
Can you hear me fine?
I can hear you. Yeah, it might be a little low, maybe. Let's see. Go ahead and talk.
Is that better?
Should be. I turned you up. I got you all the way up on mic volume.
Alrighty.
Yeah,
Let
it
me
should be
see
good.
something. Alrighty. Alrighty. And then besides that, SG&A was a major increase or decrease year over quarter over quarter, down to 14.2%. That was a very big increase, especially last quarter. I believe it was 15.3%. So you have a 1% decrease quarter over quarter. Members, 2.963 million. That was also very huge as well, especially considering they were expecting to end Q2 with roughly 3 million. And the original guidance was roughly 3 million at the end of Q1 as well. So that's very strong to see at the end of Q2. EPS $1.10, which was over 200% of a lot of analyst estimates, which was absolutely incredible. That was kind of on my neutral bull case was around 110, and then my super bull case was like $1.28. So I'm glad to see that it was around that neutral case at least for sure. From a 2026 outlook, MLR 81.5 to 82.5% full year, 15.6 to 16.1% full year SG&A, which is a little bit of a decrease quarter over quarter. And for SG&A, they did mention that there is going to be an uptick at the very end of the year. So we're definitely going to have to pay attention to that, especially after a monster beat on SG&A, or monster decrease quarter over quarter to 14.2%. So that's going to be a big thing to watch to see where that increases at the end of the year and exactly why. Earnings from operations, they increased that on the low end up 100% to 700 million. Very incredible. 243.75% beat on EPS, depending on where you look. At least 180% on depending on what brokerage you say though. So very massive beat on EPS. Absolutely incredible. Risk adjustment, I did the quick math on that, was around 19.78%. So it looks like it's still on track to track roughly around that 20%, which is going to be very huge, especially considering that last quarter was 23.9%. So seeing that roughly 19%, 19.8% is going to be very huge for the rest of the year. And wondering if that is even going to be less than 20%, just because they now have the final risk adjustment report from Wakely, but also they did have that positive prior period development, which was 130 million as of the Goldman conference. So definitely going to be very interesting to see more of that. The only red flag that I've seen really out of this earnings call so far, I haven't dived inside the press release at least so far, is that MLR and the medical costs did increase a little bit quarter over quarter, but they were expecting that, which is why they kind of went so just like with all the insurers, went more so aggressive on the actual pricing of their plans, which is why the Q1 earnings call was so low. Their operational subtracting that extra 4% accrual was roughly around that 67 or 66.9%, once you back out that accrual. So if you go back and look and compare it to this quarter, it's roughly a 10% 10% increase from that, just over. But when you add back that accrual and you have that 70.5% increase in Q1, they actually accrued for some of the medical costs, which actually decreased their top line, which is also why we saw a little bit of a higher print than last quarter at 4.88 billion. You love to see that from the total net revenue. It's going to be very interesting to see exactly where investment income, just alone investment income. I was tweeting about this a little bit before. Their investment income was making up their entire bottom line of their guidance. So if we're able to see, between ACA plans, if they end up more profitable than they originally expect, plus investment income continues to be around, 84 million a quarter, then that's going to be very, very huge because they have this massive cash flow with this massive increase in members of over 50% quarter over quarter. So it's going to be very interesting to see. I believe their short-term investments and cash equivalents is do around 8.5 million now, which is a huge increase, especially considering last year, which was around 8 or 4 million. So definitely a very big increase quarter over quarter, which is going to be, of course, contributing to that investment income increase, which that alone makes a big increase to their bottom line. When it comes to dilution was also very minimal quarter over quarter, roughly 300,000. Basic was last quarter, roughly the same, which is also very great to see because I believe Mario actually tweeted about this, and he had mentioned specifically that Oscar's now able to run because they are no longer diluting as much as they were before. I mean, year over year, if you compare the shares outstanding, it increased from 255 million to 302 million. But now that they are one profitable compared to 2024, they are especially going to be, the stock is going to react a lot more positively. Some stocks will continue to dilute, and even if they're growing very aggressively, that dilution ends up offsetting a large portion of this. But what we're seeing is that dilution is very minimal compared to the actual growth, which quarter over or year over year is expected to be around 60%, which is absolutely huge. And I will say, like right now, where the stock is like roughly $30, it's definitely still undervalued. But at the same time, I think right now it's very easy to sit on shares. 2028 leaps as well, going into 2027. Absolutely love to see it. But yeah, I mean that's my initial outlook on earnings, Ronnie. Did you have any thing to add?
Yeah, so I mean, right there at the end, I really like what you said because it's very important when we get to like when the stocks actually start running. Like we talk about this build up and we're invested and we're buying like crazy, and then the stocks actually start running. I still do think it's undervalued, just like you do. But am I out there spamming um, leaps, spamming shares, buying more? No, not right now. If we got a significant dip, then that would obviously change. But as of right now, um, I'm also just sitting on shares. I have a lot of 2028 leaps. And the great thing about those is if I want to if I want to build up my shares more, then I can simply exercise those leap contracts and pull out 100 shares at a time per contract. So I'm also just sitting on the leaps that I have and the shares that I have. I've trimmed a little bit on, like, once we hit above 30, up around 36, around 5 to 10% of my overall position. Just taking some gains off the table. At the time, I rotated a little bit into Zeta, which I'm happy with that decision. And yeah, now I'm just a very happy shareholder. Honestly, they came out and they crushed earnings. I mean, 2025 was such a rough year for this company because of the medical loss ratios, and it's just not their fault. Medical loss ratios, you can't control that. You can't dictate that as a health insurance company. All you can do is kind of ride the wave. So 2025 was supposed to be what 2026 is right now, right? 2025 was supposed to be this massive um, profitability year where they show the street like, hey, we're profitable, we're crazy, like we're hyper profitable right now, and they just didn't get to do that last year. So that's why you had such a crazy stock price movement around last year, consolidation, and then when nobody was ready for it, it dipped down to 10, $11. Mark Bertolini bought over $1 million worth, and then we obviously ran to 36. And they had, just a monster earnings last quarter, and then they just followed it up with a monster earnings this quarter. So, yeah, if you're a shareholder, you're just happy. These earnings are stellar. They lost less members than expected. Medical loss ratios, like you did say, they did tick up. But again, um, to come in this profitable still when they did tick up a little bit, outstanding by leadership. We know SG&A costs continue to come down. Like you said, they do expect them to tick up a little bit, which I'm totally fine with because they've been trending down so hard over the last few quarters and last few years. Um, you know, the EPS, just how profitable this company is getting, and then actually coming in and beating the revenue, which they haven't done. I believe in the last 2 or 3 quarters, they actually haven't come in and beat their revenue guide. So, yeah, I'm just a really happy shareholder. I don't have many critiques about this earnings. I think they came in, and like the title says of this, it's a prove it quarter. Last quarter was like a shock and awe. This was, can they do it again? And they did it again. So, very happy shareholder here. We've got about 10 minutes until we hit up this earnings call. So I did see a question. We will be covering earnings call. Yeah, there's an echo when I speak. Hey, man, it's crazy. Sorry, guys. Literally, me and Nick were, I'm not going to say that. Me and Nick were doing something yesterday on StreamYard with a third person, and literally there was issues with echo and stuff like that too. So sorry about that. Oh, now it's okay. Okay. I guess AC, like, yeah, this StreamYard's just been not that great. But I guess if one of us are talking, make sure the other one's muted or whatever. But yeah, I mean, what else can we jump into here? I mean, we can jump into a little bit more of the numbers here. Let's see.
I was going to say too, another important thing is that, I mean, if you look at just the 6 months into into 2026 as well, they already have over $1 billion in earnings this year so far. So they are in a very strong position, especially just from a general cushion standpoint. I mean, they're estimating roughly on the high end a $400 million negative hit on the second half of the year. So definitely something to pay attention to is to see, if Q3 ends up being, just over zero earnings or just barely positive or just barely negative. And then Q4 ends up being kind of that year where they get their usual negative hit, of course. It's going to be very interesting to see, especially with the MLR. Um, but the first 6 months do have a 75% MLR. And what's crazy about that is for the first 6 months of the year, they have had the same MLR of some of their best years. I believe Q1 2025 alone was 75.4%, and in 2024 was, I believe, 74.2%. So they're just barely above their 2024, I guess you could say their golden year from an MLR standpoint, and just a little bit under their Q1 standpoint in 2025, and we're in Q2 2026. So very strong numbers, especially 6 months into the year from an MLR standpoint.
Yeah, I mean, we know the baseline on MLR is around 80. So them coming in around that again, but like again, it's something they can't really dictate or handle. That's why 2025 was such a crazy, crazy year and not profitable at all, honestly, because MLR just went sky high for all health insurance companies. So now they've been coming down drastically, and that's why you're seeing healthcare as a whole run in this market. But honestly, health insurance companies, UNH and Oscar mainly leading the charge and just running this whole year so far since the dip. So things looking really good. Yeah, like you said, you got net income about 1 billion. That's phenomenal for 2026 so far on a 6-month basis. I was looking at their cash and cash equivalents, are right around 4 billion. Sorry, 4 billion, compared to 2.7 billion last year. So yeah, they're stacked with cash. Obviously, a lot of that gets paid out with benefits, their health insurance company. Let's talk about what I really want to talk about is because the business here with health insurance, it's crushing it, and they're doing very well, and I think they're going to continue to do well. What I'm most excited about, AC, is their opportunities with Lucy. I think the opportunity with Lucy, with the type of gross margins they can throw off, is immense because then it goes from a health insurance company to a healthcare tech company. What's your thoughts on Lucy, and where do you see it going? Because I haven't really got your thoughts, honestly.
Yeah, no, Lucy's going to be a big opportunity. I mean, to my knowledge, too. Of course, it's going to take time and scale, but just by launching Lucy and their ability to offer their products to employees, employers, brokers, just everyone across the board, and just have that marketplace model open, they're able to generate revenue in just about all 50 states, to my knowledge. You could just go up to Lucy, brokers can use it. They can sign up for whether it be Oscar, UNH, Elevance, Molina, whatever plan that they want to use on the ACA. They're able to use that, compare everything, and also the employer can fund an account in there inside of Lucy, and people can just use those contributions from their employer and use that. So it's going to be a huge model, and even like Mark Bertolini had even said that when you give the consumers choice through a model like this, they're going to exploit the system to the best of their ability. So they're going to pick the best plans for the value and for the quality, which so happens to end up being Oscar. I was going through some news releases based on ACA pricing, and Oscar was actually greater than 10% cheaper than roughly the national average of the ACA plans. So not only are they marginally cheaper by quite a good margin, they are also have a tech-first platform. It's very it's very high quality care when you can just compare the internal net promoter scores that they are giving out or sending out. I believe the last score was a 69, I believe, which is incredibly high. I believe they have that posted on their website, which is an incredibly high net promoter score. I've spoken to a few people that have Oscar Health Insurance themselves. They said it's very simple, very easy, very quick. They aren't waiting for a very long time to just do basic things you may need to do with health insurance, whether it be file a claim, make a payment, etc. like that. I know UNH, for example, that's a plan that my family has had personally, and it's just, it can take a very long time. Unfortunately, Oscar is not very Oscar's not in my state yet, so I'm hoping for that to be eventually, and maybe my employer will end up going to an ICRA model, which is something that I've kind of talked about a tiny bit, which would be very interesting. But ICRA just alone, I mean, the potential cost savings for a small, medium-sized business is just incredible. I mean, when you're looking at just the baseline economics of how an ICRA works, or in the ACA, if you have a 35 employer, a 35 employee, company, you have a risk pool of 35 people. If you have a few people with a critical illness, then that's going to raise the premiums for everybody quite considerably, because you're underwriting the group and underwriting the company. But when you compare that to the ACA, you're underwriting 20 million people, 20 million or so people. So it's going to be, the risk pool is much, much larger. So it's going to be a very big thing to see, especially going into 2027 and the rise in healthcare costs, because right now, every employer is looking for better options. Health insurance costs double-digit increases year over year. We're talking 15, 20% increases for many small group, large group, even the ACA. Everything across the board was double-digit increase, and it was absolutely insane. It's just how it is, especially with the enhanced subsidies going away. So it's something to really pay attention to. There was actually a survey, and it actually had a pretty decent survey size group. I want to say it was 984 employers, and it said around 62% of them were actively looking into ICRA because of the rise in healthcare costs, and whether that means that they are actually going to partake in ICRA, or if they're just generally just looking into ICRA to see if there's going to be any cost savings. 2027 is going to be a huge year to pay attention to, not only ICRA, but also Lucy's integration into ICRA.
Yeah, I agree. I didn't get into this company for Lucy. I got into this company because it was severely undervalued. Wall Street wasn't taking notice, and you had Mark Bertolini at the helm, and Mark Bertolini is just he's a man that delivers, and he's a man of his word. He said he's going to deliver. He delivers. He continuously goes out there, and he just his wealth of knowledge in the healthcare or health insurance space is bar none. His time at Aetna Group, before they were accumulated or acquired by CVS, his time at Bridgewater next to Ray Dalio. The guy knows ball. The guy knows health insurance. And, Oscar, the company, like straight up got a deal and a half being able to bring him on as CEO, because what we've seen with this company, they went from a dying company, in my opinion, to a thriving company. And I mean, they're just crushing it on all cylinders now. Earnings call. Yep, let's see if it's on.
Good morning.
Yep, it's on.
And I will be your conference operator today.
Let me get it on here.
At this time, I would like to welcome everyone to Oscar Health's second quarter 2026 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the
AC,
number
can you
one
hear
on
that?
your telephone keypad. If you would
Yep,
like to
I can
withdraw
hear
your
you.
question,
Cool.
press star one again. Today, we do ask you limit yourself to one question and one follow-up. Thank you. I will now turn the call over to Chris Potichar, Vice President of Treasury and Investor Relations.
Good morning, everyone. Thank you for joining us for our second quarter 2026 earnings call. Mark Bertolini, Oscar Health's Chief Executive Officer, and Scott Blackley, Oscar Health's Chief Financial Officer, will host this morning's call. This call can also be accessed through our investor relations website at ir.hioscar.com. Full details of our results and additional management commentary are available in our earnings release, which can be found on our investor relations website at ir.hioscar.com. Any remarks that Oscar makes about the future constitute forward-looking statements within the meaning of safe harbor provisions under the Private Securities Litigation Reform Act of 1995. Actual results may differ materially from those indicated by those forward-looking statements as a result of various important factors, including those discussed in our annual report on Form 10-K for the period ended December 31st, 2025, and the quarterly report on Form 10-Q for the period ended March 31st, 2026, each is filed with the Securities and Exchange Commission and other filings with the SEC, including our quarterly report on Form 10-Q for the period ended June 30th, 2026, to be filed with the SEC. Such forward-looking statements are based on our current expectations as of today. Oscar anticipates that subsequent events and developments may cause estimates to change. While the company may elect to update these forward-looking statements at some point in the future, we specifically disclaim any obligation to do so. The call will also refer to certain non-GAAP measures. A reconciliation of these measures to the most directly comparable GAAP measures can be found in the second quarter earnings press release available on the company's investor relations website at ir.hioscar.com. We have not provided a quantitative reconciliation of estimated full year 2026 adjusted EBITDA as described on this call to GAAP net income because Oscar is unable, without making unreasonable efforts, to calculate certain reconciling items with confidence. With that, I will turn the call over to our CEO, Mark Bertolini.
Good morning. Thank you, Chris, and thank you all for joining us. Today, Oscar Health announced strong second quarter 2026 results with significant year-over-year improvement across all core metrics. Oscar delivered record profitability for the first half of 2026, generating $1.1 billion in earnings from operations, then $1 billion in net income. In the second quarter, revenue grew 70% year-over-year to $4.9 billion. MLR improved 12 points to 79.2% year-over-year, with utilization moderately favorable to our expectations. Our SG&A expense ratio improved 450 basis points to a record low of 14.2%, reflecting disciplined expense management, technology-driven efficiencies, and continuing operating leverage. Earnings from operations increased by $619 million year-over-year to $389 million. Our performance demonstrates superior execution against the fundamentals of our strategy. Disciplined pricing, differentiated consumer products, and a scalable technology platform work together to fuel individual market growth. We are raising our full year 2026 outlook based on the strength of our operating performance and our model built for long-term profitable growth. Now I will share our view on trends in the individual market, then I'll dive into our business highlights. The individual market is vital to our nation's economy and was built for the labor market now taking shape. The market is expanding coverage for people outside of traditional employer plans, including a growing number of entrepreneurs, gig workers, part-time employees, and early retirees. Over the past decade, the market drove down the uninsured rate and prevented billions in uncompensated care. Over the next decade, its role will only grow as people move between full-time jobs, contract work, and retirement at twice the rate of prior generations. AI will accelerate that shift. Our nation's leaders should promote policies that put the next generation of American workers in charge of choosing their health care. Oscar is leading the charge with portable coverage and experiences that meet the expectations of the people powering our economy. The future of American healthcare depends on a durable individual market, and 2026 trends reinforce our conviction in its long-term strength. Total ACA membership stands at 19.2 million, down 12% year-over-year, tracking favorable to our pricing assumptions and reflecting continued consumer demand. Wakely's first claim-based report of 2026 market morbidity is also favorable to our expectations, suggesting potential upside to our outlook. We expect further market contraction and remain cautious with only 4 months of morbidity data, but we expect both trends to remain favorable to our pricing assumptions. Looking ahead to 2027, we anticipate a rational pricing environment with rates that reflect the effects of CMS's program integrity efforts. Now I will review our business highlights. Oscar ended the second quarter with 2.96 million members, up 46% year-over-year. Membership reflects above-market open enrollment growth and solid retention. Our consumer products designed around clinical, lifestyle, and cultural needs are driving higher member satisfaction, and we continue to launch features that help members find high-value care and manage costs. We are also building momentum in ICHRA with steady growth and demand from small businesses in the healthcare and professional services industries. Our technology continues to differentiate the member experience. This quarter, we piloted a radiology program with our Oswell agent. Oswell uses a member's claims history and clinical interactions to initiate their next step for care. It confirms coverage, guides members to high-quality providers based on cost, location, and availability, and shows estimated savings from switching facilities. 1 in 4 members choose Oswell's recommended site of care and save $75 on average per appointment. We will expand this capability to additional procedures using care standards from leading centers of excellence. AI is powering operations across benefits, billing, claims, clinical care, and member support. Our claims platform delivers 98.7% first pass accuracy and processes most claims in under 48 hours. We are also deploying AI in medical economics programs to identify cost signals early and act before they become trends. Pharmacy is a clear example. Our models analyze pharmacy activity alongside utilization, provider, broker, and member data to flag outliers. Root cause analysis identifies the drivers so our teams respond with precision. We expect these capabilities to generate tens of millions of dollars in annual savings. Oscar's technology is transforming the economics of the business. The team is embedding intelligence into all core workflows across our platform, making it smarter and more efficient with every deployment. As membership grows, we can serve more members without adding headcount at the same rate. That scale fuels operating leverage, expands margins, and bends the medical cost trend for us and for our members. In summary, Oscar delivered a strong second quarter and record profitability in the first half of 2026. The fundamentals of the business are strong. Our performance is favorable to plan, and our improved 2026 outlook reflects that momentum. We are entering the second half of the year from a position of strength, with the technology, scale, and operating discipline to deliver profitable growth. The ACA is the only healthcare market where private insurers compete directly for the consumer. Our job is to give consumers real choices, real price transparency, and reward what they value. When that happens, the competitive market does what it does best. It drives out inefficiency, accelerates innovation, and lowers costs. Oscar is defining that future. We are replacing one-size-fits-all coverage with solutions that make healthcare as easy to use as any other consumer product. Our results reflect the team's focused execution across our products, platform, and strategy. We will outline how we translate that performance into durable growth and long-term value at our Investor Day on September 16th. I will now turn the call over to Scott. Scott?
Thank you, Mark, and good morning, everyone. This morning, we reported strong second quarter results, and we are raising our full year 2026 outlook to reflect our operating performance. Through the first half of the year, we delivered record profitability of approximately $1 billion of net income, or $3.16 per diluted share. The fundamentals of the business are strong, and our results are favorable to our plan. Let me now turn to details on second quarter performance. We ended the second quarter with 2.96 million effectuated members, an increase of 46% year over year, driven by above-market growth during open enrollment and solid retention. Total revenue was $4.9 billion, an increase of 70% year over year, driven by higher membership and rate increases, partially offset by higher risk adjustment payable accrual. The second quarter medical loss ratio was 79.2%, an improvement of nearly 12 points year over year. Recall that in the prior year period, we recorded the entire first half impact of the 2025 risk adjustment true-up in the second quarter. The year-over-year MLR improvement was driven by our disciplined pricing strategy and a strong current year performance compared to the market reset experienced a year ago. We also benefited from favorable prior period reserve development in the quarter. Now I'll spend a moment on risk adjustment. In the second quarter, we received the final 2025 CMS risk adjustment report, which was approximately $160 million favorable to our first quarter accruals and fully recognized in the quarter. We also received the first risk adjustment report for 2026, covering claims through April, which showed market morbidity tracking quite favorable to both our pricing and first quarter accruals. With only 4 months of claims in the data, we recognized only a small portion of that favorability, which we believe is appropriate at this stage in the year. Through the first 6 months of the year, risk adjustment as a percentage of direct premiums was approximately 20%.
Okay, hold on. I just want to make sure I understand this.
Our expectations for the full year. Overall year-to-date utilization was moderately favorable to our expectations. By category, inpatient, professional, and pharmacy utilization were favorable, while outpatient was elevated through the first 6 months of the year. On administrative expenses, we delivered another record low SG&A expense ratio. The second quarter SG&A expense ratio was 14.2%, a 450 basis point year-over-year improvement and the lowest in the company's history. The improvement was primarily driven by disciplined expense management, including an increasing impact from technology and AI initiatives, fixed cost leverage, and lower risk adjustment as a percentage of premium. We reported earnings from operations of $389 million in the second quarter, a $619 million year-over-year improvement. Operating margin was 8%, a 16-point improvement year-over-year. Net income was $362 million, a $590 million increase year-over-year. Adjusted EBITDA was $415 million in the quarter, an increase of $615 million year-over-year. Through the first 6 months of 2026, our results reflect disciplined execution and strong year-over-year improvement across all key metrics. Shifting to the balance sheet, our capital position remains very strong. We ended the second quarter with approximately $10.2 billion of cash and investments, including $462 million of cash investments at the parent. As of June 30th, 2026, our insurance subsidiaries had approximately $1.9 billion of capital and surplus, including $994 million of excess capital, which was driven by our strong operating performance. Let me now turn to updates on our 2026 full-year guidance. Based on our first half performance, we are raising our full-year earnings from operations guidance to a range of $500 million to $700 million, an increase of $250 million from our prior outlook. We continue to expect total revenues of $18.7 billion to $19 billion. We now expect full-year MLR in the range of 81.5% to 82.5%, an improvement of 90 basis points at the midpoint from our prior outlook. On administrative expenses, we now expect our SG&A expense ratio to be in the range of 15.6% to 16.1%, an improvement of 20 basis points at the midpoint. We continue to expect adjusted EBITDA to run roughly $115 million above earnings from operations. Our improved outlook reflects our strong first half performance, including favorable prior period development, market morbidity trends, and an expectation of increasing membership churn in the back half of the year as CMS program integrity processes continue. As I mentioned, the market morbidity data that we received for claims through April was quite favorable to our expectations. Given this early stage in the year, we have not taken full credit for that favorability in our outlook. If the favorability holds as claims develop, that could present a tailwind to our full-year outlook. In closing, our disciplined execution drove strong operating results and record profitability through the first half of the year. We are confident in our improved 2026 outlook and are on track to deliver our strongest performance to date. With that, let's turn the call over to the operator for the Q&A portion of our call.
At this time, I would like to remind everyone, in order to ask one question, one follow-up, press star, then the number one on your telephone keypad. And your first question comes from Andrew Mok with Barclays. Please go ahead.
Hi, good morning. On utilization trends, you noted inpatient, professional, and pharmacy was favorable, but outpatient was elevated. Can you elaborate a bit on what you saw there, particularly on the outpatient side, and how you're thinking about the pace of utilization for the balance of the year? Thanks.
Yep. Good morning, Andrew. In outpatient, I would say that there are a handful of areas that we're paying attention to. Honestly, none of them is particularly outsized. And what I think is most important there is that we're seeing stability in these trends. And so while outpatient is a bit elevated, as you mentioned, we're seeing the other categories running favorable. And at this point, the trends are stable. And so, the utilization looks very reasonable and is favorable to what we would expect at this point in the year.
Great. And appreciate all the comments that AI is accelerating the shift to untraditional employment. Would love to hear what you're observing in the market driving that commentary and how that impacts your view of intermediate term growth. Thanks.
A couple of things on AI. First, we don't see the massive unemployment that a lot of other CEOs have painted a very dark picture of. We see a transition to different kind of job groups. And those are in the gig economy, that's in part-time work, that's in multiple part-time jobs, that's in early retirees. And in that economy, employer-based insurance doesn't necessarily work well. There are a lot of people who don't have coverage as a result. And we are now working with some very large groups around that part-time employees, people who work in multiple places with multiple part-time jobs. So as that market evolves, we see it as a huge opportunity for ICHRA and expanding the total TAM of the marketplace. In small group and middle market, there's 115 million lives alone that we think will have some impact on employment in growing these other jobs in our economy. As far as AI goes, internally, our investment is not something that we do separately. Every business owner has a platform. That platform has engineers, product management, AI, and business people evaluating how we can advance every one of our platforms every day to reduce friction for our members and for the providers we work with. And it's through that analysis that we fund those projects with expected returns and expected investments. I note that in the press you hear of billions of dollars being spent by our competitors, and I would just make the point that we have one platform, we have one data set. As a result, we start with a huge advantage in being able to use AI at scale without having to make the investments in platform integration and data rationalization that a lot of our competitors do. And that is why we are so far ahead in deploying AI at scale in the organization.
Your next question comes from the line of Jessica Tassan with Piper Sandler. Please go ahead.
Hi, guys. Thank you for taking the question and congrats. So first question is just, can you clarify that the 2025 reconciliation accounts for about 80 basis points of the 90 basis point MLR revision at the midpoint? And then just, do you mind helping us kind of understand what you're seeing? I mean, you helped a little bit on utilization or a lot on utilization for this year, but just how do we get comfortable that you all have visibility into utilization just despite kind of the potentially deterrent effect of higher deductibles? How do we get comfortable essentially with the reiterated or the slightly raised core MBR guide? Thank you.
Yeah, Jess, starting off with MLR and the impacts from PPD, I would say that MLR excluding PPD in the first quarter was a little bit over 82%. And MLR is impacted by two components of prior year development. There's the piece that impacts risk adjustment, which we talked about getting the final CMS report, and that was roughly $160 million. There's also favorable development around claims, and so when you look at all those things, I consider those core parts of the business, and they give us confidence that the reserves that we're booking our pricing, are headed in the right direction. So, everything there looks appropriate and stable. Turning to your question on utilization and our confidence in the back half, I would just, make a couple observations. One, at this point in the year, we've had enough, time to have a pretty good sense of the risk of the membership that we've got. I would say that it is consistent with our expectations. As I talked about with utilization, we're seeing trends that are stable. We're not seeing anything that, it looks to be, kind of pushing and running from us. So, when I step back and look at all of the components of our operations in our business, I am pleased with the stability and with the clarity and visibility that we have into our current book. And with the Wakely report that we got in the first quarter, it confirms a lot of what we thought was going to be shaping up for this year in terms of, I would characterize it as the reduction in membership that we had all planned for looks like that's coming in a bit lighter. That results in morbidity in the marketplace that's likely going to be less than what we priced for and could present a tailwind to our full year outlook.
And I would add one more thing, Justin. In our management process and the way we operate the business, in our operating plans, we actually create targets for affordability and reducing the actual trend we put into pricing. And we measure the results of our programs that we're developing, including some of the things we talked about with AI today, that go against those targets. And so we're constantly measuring the opportunity and what we call flares, where we see hotspots in the utilization, making sure we go after those immediately, that we're acting quickly and with precision and moving that utilization back to where we expect it to be.
Thank
Your next question comes from the line of Parker Snure with Raymond James. Please go ahead.
Hi, good morning. Just curious on how you guys are thinking about the 2027 rate cycle. We're seeing some of the preliminary rate filings beginning to roll through, but just generally, how are you thinking about positioning of your rates within the market and baking in conservatism for all things that could happen?
Parker, thanks for the question. We believe the market so far has been rational. And again, we price by market. So we look at opportunities by market. And so comparing the overall rate filings is probably not a good way of measuring it. Just take a look at what happened in 26 based on our overall rate filings versus our competitors. We've done quite well in spite of what people thought was underpricing. And so I would suggest so far rational. We still have another bite at the apple as we go forward. And as we look at what could happen with the MBPP or the stay, which we probably don't think will be released at all this year. But in event it does, we have an opportunity to change product and pricing should we need to do that. So we have more time. We're on it every day. We already have plans in place on how to do changes if we need to make them. So we're pretty confident that we're in a good place.
And if I can just get a follow-up, but I know it's early, but how are you thinking about the overall ACA market enrollment in 2027 at this point in time? Do you think, I know there's still some unknowns, but do you think it's relatively flat, or you see some more declines, or just some general thoughts there?
We think that based on what's already in place through regulation, because we are reacting to a few program integrity efforts through CMS that are coming through in regulation and review, that absent any dramatic changes to the MBPP, which again we don't think will happen, that the market, that a lot of the program integrity efforts have been built into the marketplace. We think we're through all the enhanced premium tax credits impact from 2026. So we think that the market has opportunity in it. Obviously, we're not resting on our laurels, and we're looking at things like ICRA and other markets to grow our total available market, but we believe there's still opportunity for the market to remain stable or grow and for us to take share.
Your next question comes from the line of Stephen Baxter with Wells Fargo. Please go ahead.
Hey, thanks for the question. I wanted to follow up on utilization. It looks like medical expense was up 17% quarter over quarter, and I think probably 20% on a PM basis. Could you give us some color on what's driving that? It seems like a much sharper increase than what you might normally expect, but obviously there's a lot of unusual dynamics this year. And then how should we think about kind of either the upward sloping of MLR or maybe medical cost expense PM as we move through the balance of the year? And then I have a follow-up. Thank you.
Yeah, thanks, Steve. I think that in utilization, we're really seeing and translating that into MLR and PMPMs. We're really just seeing the seasonal pattern of the membership that we have this year. And so, as we've talked about, we saw some transition in our book from silver into higher deductible bronze plans. We also have more gold membership. So, I do think that the seasonality that we're expecting is emerging. I would expect that that's going to continue to pick up into the second half as members burn through their deductibles. So MLR from from the first 6 months, I would expect it to continue to trend, higher quarterly, and the seasonal patterns will look, I think, pretty similar to what we've seen historically.
Got it. Okay. And then just to follow up on that, you have obviously a lot of new members this year. You also have like a lot of new members in new products. Can you speak at all to the performance of new members and some of the new products that you rolled out this year, like the new bronze and the new gold that you're speaking to? Thanks.
Yeah, I would say that when I look across the book, we're really pretty pleased with the performance overall of the new products, membership behaving, as I talked about, pretty consistently with our expectations. The risk in the book looks very much with what we would have expected. So, we're not really seeing any deviations in any particular metal. It is an interesting situation where bronze now has a lot of members that moved out of silver and moved into bronze. Gold has members that moved out of silver and now in gold. So, you can't really look at these metals in the same way historically. So we do a lot of, trying to refactor how these metals are going to perform, and against those, adjusted expectations, I would say things are performing, consistent or favorable to our plan.
Your next question comes from the line of Scott Fidel with Goldman Sachs. Please go ahead.
Hi, thanks. Good morning. First question, just hoping you could maybe just decompress the SG&A performance was quite strong in the quarter. Maybe walk us through that, and then were there any timing dynamics that in terms of expenses that maybe sort of played out in other quarters, and then also maybe just talk about as you look towards the rest of this year, how you're thinking about investment spending that may be in SG&A as well.
Yep, sure. Good morning. So SG&A, I would just say that, as Mark talked about, we've really made tremendous progress in SG&A, and both in the quarter and in the 6 months, I don't think I would call out anything that is driving the trend. What I observe there is that there are higher taxes this year, exchange fees that we're experiencing. We're basically offsetting that by efficiencies in our variable costs that are really being driven by a lot of the AI and other technology innovations that we've been putting into place. So I would characterize our SG&A as being, what you've seen in the first 6 months is a good indication of the rest of the year. I do think that we'll see the fourth quarter will be the highest SG&A ratio on a percentage basis. That is typically the pattern for us, and that really reflects our investments in future growth and getting ready for 27 enrollment. So from here, pretty stable third quarter, and then an increase in the fourth quarter.
Okay. And then just wanted to ask about, just with some of the shifts that you have in the metal mix and with the shift to more bronze, how that affects the risk adjustment accruals that you're making. Clearly, it seems like utilization, is coming in favorable, but at the same time, you also have the metal mix shift, I guess, and now that you've had the Wakely report. And if I could just layer into that, into the metal mix question, because it's interesting, you guys have that perspective, I guess, because obviously there's a big focus on seasonality in the exchanges with the market mix shift to bronze from silver, but you have the perspective of having both the bronze and the gold. How was that seasonality playing out so far this year in terms of, did you see, what would be expected in terms of different type of seasonality around the higher cost sharing bronze and sort of lower utilization as a result of that in the first half compared to gold, or was there any other observations that you found interesting there?
Yeah, I would say that on the metals, against our refactored expectations, again, recognizing that a lot of our members that were historically silver are now in different metals, the performance there is coming in in line to favorable with our expectation, and the risk is as we would have expected to slightly favorable. Just a comment about risk adjustment. So in general, we're a risk adjustment payer because our members skew younger. They're healthier. We tend to be more urban than the overall market, and that is particularly the case as we grow. Risk adjustment really is driven by morbidity, not necessarily plan design. I've talked about this in the past, but the risk adjustment formula is intended to neutralize the impacts of the different benefit designs by different metals. That's always not a perfect, exact science in terms of how those algorithms work there. But what we are seeing is we're getting what we would expect in terms of claims activity and the risk adjustment benefits from that. So, at this point in the year, which we do have now, we're 6 months into the year, so we've got some visibility into this, and all things are looking like they're running as we would have expected.
Your next question comes from the line of Raj Kumar with Stephens Inc. Please go ahead.
Hey, good morning. Maybe kind of focusing on ICHRA and I guess, yesterday's announcement with a partnership that you are undergoing with ICHRA X. So curious on, what type of capabilities that offers to your current platform, and kind of how should we be thinking about kind of the kind of pace going into 2027 for that offering?
So ICHRA X is an EDE that we built off of an ACA-approved, CMS-approved electronic data exchange that we purchased last year. We mentioned it in, I think, the third or fourth quarter call last year. And that EDE has a lower cost structure than current ACA alternatives, as well as agreements to have all of our competitors as part of that platform. So we now have the rails upon which to run ICHRA, which has not been the case in the past. How do we convert members from a defined benefit to a defined contribution? How does the employer step aside and allow these people to sign up? And what happens is, because network's always an issue for employers, because they have to have wide area networks at higher costs, by the way, than we do in the ACA with narrow networks. Those employers want to know how we can get member coverage. And what we tell them is that we have all of our competitors on the platform, and the members can select whatever competitor they want that has the network they need. So all of a sudden, we have the largest PPO network in the nation at narrow network rates. And what that allows those employers to do is to stand down on the issue of, is there enough network coverage? Couple that with benefit selection tools that we're using with brokers to get people into the right plan design, allows savings as high as 26% of the employer's cost versus what the employee would need to pay by following this option. So that EDE, that ICHRA X, invites all of our competitors to the table. They've all joined. We all get access to all those members as they convert. And then the real opportunity is on the front end of the conversion with the employer, where they spend sizable sums to convert from defined benefit to defined contribution, where the revenue is not regulated like insurance revenue, doesn't require reserves, and has higher margins. And so that will allow for competition in that market. ICHRA X is then connected to Lucy, where we are now starting to have Allstate Health, we have Aflac, we have a lot of retailers that want to get access to our members. Mark Cuban is talking to us about coming on board. Other organizations that want to join us to be able to offer retail opportunities to our members once they have to shop for their out-of-pocket costs as members in the program.
Got it. And then maybe as a follow-up, just kind of more on the technical side, I guess, kind of looking at, your short-term investments that kind of increased quite a bit quarter over quarter. So curious on kind of that underlying dynamic, given just the cash kind of being pretty steady quarter over quarter. So any color on that would be helpful.
I mean, the investment is to get the platform ready. And so, but it's not sizable. It's not a big number. It's a pretty easy to use platform and easy to change platform.
Your next question comes from the line of Jonathan Young with UBS. Please go ahead.
Hey, thanks for taking a question. I guess when you guys think about the pricing that's being put into next year from yourself in the market, do you guys kind of see that yourselves getting incrementally better G&A leverage, just given kind of your productivity efforts and the pricing that's going to go into the market? Or should it be a little bit more muted relative to the improvement that you're seeing this year?
Appreciate the question. Look, I think that we set up some long-term targets, and one of those was around SG&A ratio, and we're basically getting there a year ahead of plan. I still think there's opportunity for more leverage if we grow the top line faster than our cost structure. That's going to be a positive in terms of that ratio. So given everything we're doing with AI and focusing on running the most effective and efficient operation we can, I think there's more opportunity for improvement going forward.
Okay. And then I think in your prepared remarks, you said there was an expectation of increasing membership churn in the back half of the year. I just wanted to be sure, is that in line with the previous expectation of that 1%-2% per month, or is it going to be a little bit more elevated than is typical? Thanks.
Yep. So we ended the second quarter, as we talked about, with 2.96 million effectuated members, which is basically flat in the second quarter. And so what we saw in that quarter basically was significantly better than our expectations. So lapse was quite favorable. Some of the lapse that we expected in the quarter, is related to CMS eligibility and data issues that we now expect to happen in the second half of the year. So I would expect that churn, we previously thought it was 1%-2%. It's probably going to be closer to twice that amount. That's really a timing move and doesn't impact revenue. You can see that we reaffirmed our full year guidance on revenue. So I would characterize that again more as just a delay in those members being unenrolled versus anything more fundamental in terms of the ongoing churn that we would expect in the business.
Your next question comes from the line of Michael Ha with Baird. Please go ahead.
Thank you. Firstly, clarification to MLR. Scott, you mentioned first quarter MLR ex PPD was, I think, a little over 82%. For this quarter, if I exclude the favorable PPD and prior year risk adjustment true-up, I'm getting something around like 85.2%. Is that roughly correct? I know you mentioned utilization was moderately favorable. So just wanted to confirm 85.2 is what you're thinking about as underlying MLR, and if there's anything to note even on like monthly cadence, was the favorability pretty consistent throughout the quarter? Any moderation of trend?
Yeah, as I mentioned, my math says that if you exclude the favorable PPD in the quarter, you do get a MLR that's approximately 82%. So we'll have to do some reconciliation with your numbers after the call. But I would say that we have seen, again, 100 in total favorable prior period development of 164 million in the second quarter. Year to date, that's 232 million. So those are the numbers that you should be excluding if you're looking to try to adjust our second quarter or 6-month MLRs.
Okay, thank you. And multi-parter on risk adjustment. So if I exclude the prior year true-up, I'm getting current year risk adjustment transfers about, I think, 17.9% of premiums, a lot better than the 20% expectation. So first question is the implied transfer payable percentage in your updated guide for back half still 20%? I mean, I guess for full year, what is implied for back half? And Mark, you mentioned the June weekly could actually suggest upside to your updated guide. Curious if you could elaborate more on that. What does that layer possible conservatism look like within the guide? How much confidence do you have in the durability of it through year-end? And also, like, what types of, I guess, scenarios in the back half of the year do you think could even pose, a threat to full year expectations when it comes to risk adjustment? Is it membership attrition running hotter or something else? All right. Thank you.
Yeah. So on risk adjustment, I would recommend that you look at the first half as the best lens in terms of what's going on with risk adjustment. And in the first half, risk adjustment was 20%, which is, continues to be our expectation for the full year. So, there was modest favorability, as you talked about, in Q2 related to the final CMS report that's embedded in the quarter. But overall, again, every quarter we're doing a kind of a year-to-date true up and what our expectation is around risk adjustment. And so the fact that we were at 20 for the 6 months and we continue to expect 20 for the full year, I think shows that things are progressing as we expected.
Your next question comes from the line of Dave Windley with Jefferies. Please go ahead.
Hi, thanks for taking my question. Mark, the company invested a lot in working with your sales channel to navigate members between products for 2026. In your earlier answer, you talked about 27 being relatively stable. I'm wondering if you also think your tier mix will be relatively stable, or do you see more of that navigation? And then I think a product like Helomeno is new to 26. Do you have any plans of similar sort for 27? Thanks.
Yes, we do have new products rolling out. We continue to innovate and by market. So we expect that there will be more opportunity to move people into better plan designs that work for them, and to demonstrate more of our capability of developing these kinds of products, along with the tools like the radiology tool I talked about in our talking points, which goes alongside the pharmacy tool we talked about in the last quarter. We have more of those coming along so that it assists people. And our whole idea is, can we reduce friction at every opportunity when we invest in the platform, thereby reducing barriers for people to get the care they need when they need it. So yes, we have more navigation to do. It's not as significant as the level we did last year with the enhanced premium tax credits. It's more about delivering on new products in certain markets.
Your next question comes from the line of Kevin Fischbeck with Bank of America. Please go ahead.
Great, thanks. Just want to try to help bridge the increase in guidance. Obviously, with Q1, you didn't change guidance, but you had 164 of PPD this quarter, 68 of PPD in Q1, and then 160 of 25 risk adjustment this year. So those things all seemed incremental to your original guidance, so like $392 million, but you raised the income guidance by 250. So can you help kind of bridge the delta between those numbers?
Yeah. So first of all, the 2025 risk adjustment of $160 million is the largest part of the total Q2 favorable prior period development of 164. So the RA is a subset of the 164. As I talked about, there's $232 million of total favorable prior period development through the 6 months. And, we raised guidance by $250 million. We think that the core business is running, really well. When we got the first 26 Wakely report, I would say that was, again, it's quite favorable to our expectations. We know that report is based on early stage claims, and there will be some evolution there in terms of, how that evolves. And so we're not banking on, all that favorability coming through. That's not part of our guide. But I would just say, we feel like there's more, tailwinds than headwinds in our outlook, and we're well positioned to have a strong rest of the year.
Okay, great. And then I guess one of your competitors talked about the IDR process being, a headwind to them, and obviously that can be a bigger issue that the more narrow the networks are. So just love to hear kind of your thoughts about how the IDR process is working relative to your expectations. Thanks.
Yeah, I mean, I think IDR is part of the business. I think we support the ultimate goal, which is to protect members from cost surprises. Those are all good things. But for us, I would say that IDR is not a trend driver.
Your next question comes from the line of Justin Lake with Wolfe Research. Please go ahead.
Thanks. Good morning. Mark, Scott, you guys have both mentioned CMS program integrity efforts and the impact on second half enrollment a few times during the call, and I wanted to follow up here. I talked to one of your peers who indicated that in June, CMS sent out a list of 1 million members that they believe might be unauthorized due to a lack of Social Security numbers and 0 claims. And also heard that about 80% of these members are in Florida and Texas, which I know are 2 big states for the company. So I know you expect some impact here in the second half. So curious if you could share with us how many of these million members were Oscar members? What percentage do you think you can hold on to or save? And what financial impact do you expect the potential loss of the rest of these members might have on your results, given lower utilization of these folks?
Yeah, appreciate the question. I would just say we continue to see CMS focusing on eligibility verification, and that that is a topic that they have been really focused on throughout the year. In my comments, I talked about the fact that we expected to see some disenrollments in the second half that we had thought would start happening in really Q2. So, that is something that we continue to anticipate. With respect to the financial implications, we don't recognize revenue for members that we anticipate are going to be disenrolled. We set up the payments that we receive from CMS as a liability on the balance sheet. And all of the impacts of what's going on across the industry with payment integrities is baked into our full year guidance.
Got it. Is there any way you could share how big that assumption is relative to what CMS sent you here in terms of the enrollment that they expect might not be correct?
Well, I would put it this way. We're reviewing the file that we received, and there are a number of cases where we know that people were authorized appropriately. There are a number of cases where we've actually had contact with people. So their list was based on a set of assumptions that they went through on the file. The actual result will depend on our ability to go through those files, and we are going through them actively. And the appropriate accommodations for what we might think being lapsed members are in our guidance that we've shared with you.
Yeah, and I think we've got good visibility into that. So, I don't think this is an area that we see as a risk to the rest of the year.
There are no further questions at this time. Ladies and gentlemen, that concludes today's call. Thank you all for joining. You may now disconnect.
All righty then.
That was right.
What's that?
It's pretty strong overall. I am echoing on though.
I think they did good. I think.
Yes. So a few things that I noted throughout. Am I echoing for you?
Yes. I'll mute. Try that.
Is that better?
Still an echo. All right. I'll hit up my thoughts real quick. Am I echoing?
No.
Okay. Echoing from AC. Okay. So let's just talk about the elephant in the room. People are wondering why Oscar Health went from plus almost 20% down to negative 5%. And it's probably, in my opinion, based on the fact that, yes, Oscar Health crushed it last quarter. Yes, Oscar Health is crushing it this quarter. There's really no blemishes in this earnings report. It's just the fact around guidance. I was crunching the numbers, and with guidance, well, we already know if you're an Oscar shareholder, you already know that throughout the year, things get tougher for health insurance companies, especially Oscar Health. Things get tougher throughout the year. There's more expenses, there's more payoffs, there's more money going out than coming in into Q3 and Q4 for Oscar Health. And so they're guiding for 500 to 700 million in operating margin. So that's going to put us more than likely back-to-back negative net income and back-to-back negative EPS quarters, right? So the next 2 quarters are going to be more than likely negative EPS GAAP, negative net income on a GAAP basis, and that's going to bring them down the next 2 quarters. But overall for the year, we're looking about $1.72 to about $2.10 of EPS on a GAAP basis for fiscal year 2026. And so if you run a simple PE, if you look at a 16.4 times PE, which is what they've had over the past 5 years, then you're looking at a company that's fair value today in the range, and just based on these metrics, fair value today around $28 to around $32. But I don't know about you as an investor, I don't look at a company, and obviously I'm invested and have a much lower cost basis than $28. My cost basis sits, right around 15, 16s. I don't look at this company. Well, I mean, if you're buying today, then sure, or if you bought at $36, sure, that's not the greatest, right? Because you're looking at a company that you bought a little bit over today's fair value. But when I look at this company, I really care about what they're going to be doing over the next few years. And what I just told you about them basically being at the low of their fair value today, it doesn't include Lucy, which would bring massive gross margins to this company if they were able to knock that out of the park. It doesn't include ICRA. And Mark Bertolini talked about this on the call today. He talked about how ICRA is a massive opportunity. But the one part that I really liked that Mark Bertolini said during the interview was the fact that while all other CEOs out there, not all, but most other CEOs are all doom and gloom around the world of AI and the rapid world that is changing in front of us, he is not doom and gloom. He said he is seeing he's seeing these people find careers in just different realms and sectors. And it really spoke to me in my head. How many people do you know in your personal life that have more than one job, right? They might have their main job and then they might have their side job, right? I'm pretty sure AC over here has just I don't know what you do, AC. I know you're in the financial realm. I'm pretty sure you have a normal job and then you have social media as a side hustle, right? And you might make a little bit of money from ad revenue or whatever. Is that accurate, AC?
That's correct.
Awesome. So AC over here is in is doing multiple things, right? But then there's also some people like myself where I'm a trader, I'm an investor, I run a community, right? I make some money off X ads, I make some money off YouTube, right? So on and so forth. And I wrapped all this under a business. That my trading, my investing, it's all wrapped under one business. I am not some normal person in a normal job where I'm just going to fall under normal health insurance standards, right? Typically, if you're basically what I'm getting at, sorry, I'm ranting. Basically, what I'm getting at here, guys, is that a lot of people nowadays are going out there and they're doing their own side hustles, and some of them are starting their own businesses with it. Some of them are doing Uber driving, some of them are doing game streaming, some of them are traders, some of them are content creators, so on and so forth. And all of these, all of this realm gets you expansion in ICRA markets. Okay? Because all these people don't really fit in to this, well, let me pay for health insurance and branch it across everybody's health insurance issues and medical conditions. It like it goes on with medical insurance right now whenever you wrap it into like one workflow, like with one when you have your work pool of people that are, oh man, I'm losing track here. You have you have your work pool that gets basically severed into multiple areas to with health, different people's health conditions. So everybody has different health conditions, and all of those cost different amounts of money, right? Some people have type 2 diabetes, some people are healthy as a bull. But they take the average across that pool from that work. I'm not getting the name right. The combination of workers, right, out of that pool. So if you're just an individual person, you don't want to be in this pool of other, especially if you're an individual healthy person. If you're just an individual healthy person, why would you want to be in the same pool of other workers where these people are very unhealthy, these people are kind of healthy, and these people are super healthy, right? Because then the average cost of that health insurance is going to be higher than you would be paying as just a normal healthy person. So that's where the ICRA market really comes in, to really get down to this person that is doing social media, doing Uber Eats, doing some sort of main job, but not like main normal job as we've all grown to become accustomed to, right? So yeah, I hope that came across properly, right? This health insurance is very hard to explain. So hopefully I did okay trying to break that down for you guys. But that is the massive opportunity in the ICRA markets. It's not going to happen overnight, obviously, but I did like how Mark was talking about that, because he is right. Yes, AI is going to take some jobs and make some jobs obsolete. But what I've been seeing in this world of AI is that people at a rapid rate are starting more businesses. People are doing more side hustles. People are just getting out there and doing more, whether it's main normal job and then side hustles, or whether it's main normal jobs and then side hustle becomes full time. Like me, I was in the Air Force, and I was sitting there, and I was a trader and I was an investor, and I was doing very well with it, and I continued to get better. And once I knew that it was consistent enough, then I decided to get out and bet on me. And then I went from a very steady career in the Air Force, which I could have did 20 years and retired and got a retirement check for every month for the rest of my life. But I bet on me, and I got out, and I said, no, I've shown that I can consistently make money in trading and investing. And here we are. And then I started posting a few years after that, and bada boom, bada bang, here we are, right? I now wrap our health insurance for my family under my business. So it's different, but yeah, the ICRA market is, I do believe it will grow and become a big thing. But also with that $28 to $32 fair value today, you're not including Lucy, like I said, you're not including ICRA markets, you're not including what if ACA subsidies come back online in 2027? We just don't know. There are a lot of exciting things with this company outside of that. So if you're just looking at it and saying, okay, well, if I'm looking at this PE, I don't really want to be buying here today. And that's fine. I'm probably not buying until closer to like definitely sub 28, probably closer to 25. But I just ranted a lot. See if AC's mic is good.
Yes, is that better?
Yep, that's better. What do you think
Okay.
about all this? What's your thoughts? I just ranted a lot.
Yeah, I personally think that the earnings call, of course, was really great. Few notes inside of it is first, he had mentioned risk-adjusted favorability. That's going to be a huge portion of it. They ran the numbers a tiny bit. I believe they said 232 million total favorable risk adjustment, and 164 million was recognized in the quarter. So that means there's a $68 million reserve bank. With $68 million reserve bank, it's going to be very huge going into the rest of the year. They did mention a few times that there's going to be more tailwinds and headwinds going into the future, and that there's potential upside to the trend, and that they haven't taken the full your positive effects of risk adjustment. It looks like I still might have my echo.
Maybe try now that I
Another
took
thing to
the
note
other
is
thing
that there was
off.
an increase in fees this year, which was offset by the AI efficiencies. That's going to be huge for 2027 because in 2027, they had actually noted that a lot of the fees are going to be going away in the future as a result of the ACA marketplace from a broader perspective ended up being a little more favorable than expected. Okay. It's better now. Okay. So that's going to be absolutely huge going into 2027. One, you have, of course, lower fees from the ACA. In the ACA, from a broader perspective, that was a major portion of their SG&A ratio. I believe if you go into their income statement and you look at the SG&A portion, I believe you have to go to the actual filing to see it. But the SG&A, a big portion of the SG&A was actually taken up by taxes, fees, premiums, etc., stuff like that. And if 24% of their SG&A, 24% of their SG&A ratio, rough percentage off the top of my head, is made up of taxes, fees, premiums, etc., going into 2027, hitting that 5% margin is going to be very easy. I don't want to say easy, but very, very, very plausible compared to 2026, which is going to be very huge, especially because that was management's target to have that by year 2027. And when you have taxes, fees lower, plus you have the annual price increases and premiums, between both of those, they're going to be they're going to have a very strong setup going into 2027. Potential increase in gross margins as well, just from Lucy, getting any potential impact from Lucy. So 2027 is going to be setting up for a very massive year. They did mention a few questions from a few of the analysts at the end that were revolving around 2027. It doesn't look like, I believe by now they would have filed, but it doesn't look like they're going to be in any new states this year. They're going to be focusing on the states that they're already in, which they have a lot of states as well that have very low membership. I know Florida has been an absolutely huge one that they've been double downing, have been completely just going full steam ahead on that. I believe that is their largest category still. We don't have the updated membership numbers yet. They usually file those with their annual filing. But I believe it goes Florida, and then they have a few others, which are some states that have a lot more opportunity, especially compared to the market. Right now, they have, I believe, of early 2026, 17% of the total ACA, but 30% of the market share for the states that they are actually in. So there's definitely going to be some market share for them to gain on that. You have a few major exits from a few major ACA insurers. I believe this year. Last year, you had a bunch, Cigna, Aetna, UNH lost a bunch, Molina, Elevance. There was a bunch of insurers that are leaving, left 2025 for 2026, and they're going to be leaving 2026 for 2027 as well. So there's a lot of opportunity. Oscar also had some auto-assigned members. Those auto-assigned members, of course, is an absolute positive for 2026. And I'm assuming the same thing is going to happen for 2027, especially because Mark Berlini has connections with CVS Aetna. I believe they got a bunch of members from Aetna as well. So that's going to be very interesting to see how it actually affects going into 2027. In terms of valuation right now, just like Ronnie said, you put a 16 PE on Oscar, for example, and it doesn't factor in a lot of major things like ICRA, Lucy, etc. And also, something important to note is 2026 is like their first year where they've had a great opportunity and like a full steam ahead chance to actually move forward and actually hit profitability. For example, 2024, their SG&A ratio was much higher, their scale was much lower. In 2026, that is really where things, one, have changed, but also in 2027, that same trend should occur as well. especially most importantly with their AI efficiencies and just SG&A efficiencies across the board. 14.2% SG&A ratio in Q2, 15.2 or 15.3% as well in Q1. Very important to think about. Q3 is probably going to be an also lower SG&A ratio, but then Q4 as things really pick up, I'm assuming they're going to have broker partnerships, a lot more money spent on advertising, etc. That's going to pick up pretty heavily towards the end of the year, especially if you want to have that strong growth into 2027. So of course, between 15 and 15.3, I believe, or 15.2 in Q1, 14.3, that averages out to somewhere in between the high 14s. Comparing those and everything combined, you put like a 25 PE on this, for example, or a 20 PE even, you're talking $43 by the end of the year easily. You put a more aggressive PE, especially considering the fact that Oscar's grown quite substantially, I believe 60% year-over-year revenue growth, then, you could put a more aggressive PE and see what happens. But most importantly, the famous quote by Mark Bertolini that actually is going famous has been going famous for quite some time on Twitter, etc., of hitting that one-time price to sales. You hit that one-time price to sales, hitting that 5% margin, the price to sales, that would also be supported by the PE. So if the PE and the price of sales are both supporting each other, that's going to be very strong to just have like a baseline idea of exactly where everything should land by the end of the year. Another thing too is if you use that same comparison of taking that 5% margins equal one-timing price of sales, if you have around 3.7% margins, which is what has been kind of signified, kind of hinted at through Oscar earnings, you're at a 0.74 price to sale, and that puts you around what is that, around a $15 billion market cap roughly, which is still a pretty decent upside from here. I believe we're still at around 9.9 roughly. I believe, Ronnie, if that's correct, around a $9 billion market cap now. So that's still around like 50% upside, 55, 60% upside from here, especially if things all go well. Very important to note too is the prior period development or the risk adjustment reserves. It seems to be around 68 million. I believe if I heard correctly, 232 million total positive effect, and then they only realized about 164. So that's very important to note. Yes, in 2027, I could definitely see that. Seeing more members and others leaving compared to that. There's going to be churn towards the end of the year, especially with the rise in healthcare costs. They were expecting initially dropping down from 3.5 to 3 million members at the end of Q1. We ended up seeing that rough 3 million number by Q2, just below it right now. But they initially expected 1 to 2% monthly churn from Q1, which ends up putting us around like 2.7, 2.6 million members by the end of the year, where Oscar's much higher compared to that, on track for a much higher number than that. At this rate, probably 2.75, 2.8 million members by the end of the year. And then, of course, with 2027 expansion, not from an actual statewide perspective, but from just the markets within the state, that's going to put them up probably back over that 3 million member number. But of course, the member count growth isn't going to be the largest contributor to Oscar's revenue growth as well. It's going to be a mix of a few things. One, you're going to have the actual increase in members. You're going to have the increase in the revenue from the annual price increases. You're going to have Lucy as well. So it's going to be very interesting to see. Did you guys hear the news from the conference call webcast? Which part are you referring to? I know they were mentioning something towards the end of it about, I couldn't quite understand what he was saying at the very end. I have to look into that more, but some sort of a report that came out that was like referred to like an audit in Florida, revolving around subsidies and people, inputting the correct information, I believe. It's something to look into a little bit more, but also what's very interesting is Oscar has been just about the most proactive out of all the insurers when it came to, anything revolving, anything around fraud or subsidy, waste, and abuse, etc., stuff like that. They were actually working towards the end of 2025, specifically with the CMS and other programs to really ensure that their book is actually proper, especially going into the end of the year. That major drop off from 3.5 million to that 3 million was from that subsidy drop off. And as they said within the call, is that first off in Q1, that 400,000 was a lot of the one, fraud, waste, and abuse, and also the $0 premium members that ended up going away, mainly because they were paying $0, going from $0 to $400. If they're not going to be actually collecting, and they have that reasonable suspicion that that is not going to actually be collected, then they're not going to end up recognizing that revenue. And that's exactly what they said in this earnings call specifically. They report effectuated membership. I believe they made that change in Q1 2025 or maybe 2024, where they started reporting effectuated membership, which is their real members, what's actually expected. So that's very important to note that those are real members, that those are real paying members that they expect to receive payment on. Those are not, inflated numbers. That 2.94 or so is real membership that definitely needs to be taken account, that they're actually recording revenue for. By when you think they can achieve 5% margins, 2027, I'm very confident. 2026 is very interesting. In my most bullish case scenarios, I thought 5%, 5% could happen. It definitely still can happen. But I'm more leaning around that 4%, especially, you take that 19 billion and you consider that 700 million number, you're looking around 3.7. When you're looking at 3.7% margins, 0.74 times price to sale, looking very strong towards the end of the year. Something that is very important to look at. But the big thing that's going to get them there first is, especially mentioned inside the call, the premium taxes and fees are huge this year. The premium fees increased quite significantly. Going into 2027, it's going to be a lot lower. I believe their fee expense, I was trying to run some hypothetical numbers, and the fee expense could drop like 40% or so, I believe, which of that SG&A line item, running some hypothetical scenarios would be around a 25% decrease, I believe. Of course, very hypothetical. We don't have enough insight into those specific line items, unfortunately, on a line-by-line basis. I can scrub the filings again, see if I can find anything. But I don't think there's enough of a breakout to really put like a first certain number, but there's going to be a lot of positive in 2027 in terms of that. With increased costs for health insurance companies the latter half of the year, in terms of expenses with deductibles.
Yeah, so on a trailing 12-month basis, I mean, if they just get a little incremental, if they just get a little bit better than Q3 and Q4 2025 on their margins, then they might be able to hit 5%, right? Because they've been able to do on a trailing 12-month basis around 4.1 on operating, about 3.6 on net margins. Free cash flow is obviously great, but they got to pay a lot of that out. Overall, make sure I'm not muted. Overall, yeah, they're trending in the right direction. Obviously, 2027, like the biggest thing is we just gotta make sure that, I mean, they gotta make sure they price right for potential higher medical loss ratios again. Because if you have another 2025, then things get ugly very quickly. But that's where I think 2025 was an outlier year, and typically with medical loss ratio, you don't get like multiple years of elevated medical loss ratio. It's typically like an outlier, and then it trends down over time, and then you get another outlier years later and stuff. And then obviously you have Lucy, ICRA, all these different things that they're moving into to help them with their margins, help them grow more business, help them grow into a higher valuation. Obviously right now they're down around 7%. Honestly, where could we go from here? I mean, you can have a pullback down here to around 25. The fib retracement levels are pretty deep, not gonna lie. So for a smart money zone, you're looking at a $16 to $17 range, and I really just don't see that on what they've been able to put up and what they're doing. Something drastic would have to happen. The healthcare market is moving up and to the right. The healthcare market is bullish this year. Oscar's bullish this year. So for a pullback, I see basically somewhere in this range of like 23 to 28 range, somewhere in here, right? That's where I really see the pullback range. Honestly, after this report, AC, I'd like to get your thoughts on this. And we're just spitballing here. Obviously, the only thing that really moves the stock price is people being bullish about the company and bidding it up. But we will have 2 more quarters like this. Like they're expecting negative 25 cents, and then the fourth quarter is usually the worst quarter of the year for Oscar. So the next 2 quarters are going to report net income losses. They're going to report EPS losses on a GAAP basis, and it's going to bring down the overall total. But again, that's where we're talking about a $1.70 to $2.20 EPS on a GAAP basis for the full year of 2026, which is massive when you look at this company in 2025 and how they got hit with their profitability. This was all supposed to happen last year, but medical loss ratios hiked like a crazy amount. So if you told me that we're just gonna like pull back and chop around from this $24-25 range to $28 range until September is going to be a big month. September they have their investor presentation. That's going to be a big month because we're going to hear about Lucy, we're going to hear more about ICRA, we're going to hear more about Oswald, and markets are forward thinking. So we already understand that fair value today is between $28 and $32. If they really wow at the September investor presentation with Lucy and Oswald and ICRA, and people really start buying that up, then yeah, you could start getting a move up to 35s and maybe 40 going into the year end. But yeah, it's really tough because they are going to be reporting negative GAAP net income and EPS for the next 2 quarters, unless they have a shocking surprise, but most likely not. So that dampens things a little bit, right? Because people see that and it's like, oh, well, negative. But if you just look at the overall year, it's not. I would honestly rather have it be reverse, like do first quarter, second quarter, bad, and then third quarter, fourth quarter, really good. And it's like, because you're building, like it's kind of going the opposite direction. So yeah, I think price moves based on coming in and losing less, obviously, if they're able to continue to stay on track, and then obviously getting people excited around Lucy and showing that these are real viable businesses for this company to spin into. And yeah, that's kind of what I think. So price action wise, I probably wouldn't expect too much. What's your thoughts, AC?
Yes. I was going to say the price action is very interesting, that's for sure. No, for sure. It's definitely very interesting. I mean, the stock is down a little bit right now. I think the only comment that I've seen really out of the conference is he wasn't the most he didn't I wish he kind of went a little more in depth into how they were going to achieve 2027 growth. Of course, you have the annual price increases. I mean, that's a given. They're going to, of course, do what they did last year and expand their broker network inside of their current states and all. But I definitely would have liked to heard more on exactly how they were going to, achieve 2027 growth. That's the only comments that I'm really seeing, like out of basically what I have seen to really send the stock down. I mean, you have 200% EPS beat, roughly, depending on where you look. Some say 189, some say 225. That would have been like the most important thing for out of all like the negative comments I've seen for them to expand a little further on 2027 growth drivers. From a revenue and earnings standpoint, there are 100% a lot of growth drivers. I just wish you would have went into them a little bit more. I think the market would have liked that a lot more. Also to consider, when you have a 200% EPS beat, it was definitely probably the algos pumping it this morning, see 200% to like, holy crap. And that's probably why it kind of like short squeezed pre-market basically, with 20%. Um, but it's definitely a strange point, because kind of what we saw last year is it's a tough point because of course going into the end of the year it is still undervalued. Like it's very clear, especially they have a reserve development. They had mentioned multiple times like there's room for expansion, but at the same time we are kind of going into a little bit of a quiet period until the investor day. Have a month of basically no news going on. The price can go basically anywhere, and it's kind of the same thing that actually happened after Q1. Of course Q1 was to the positive, but of course, we'll have to see what Q2 ends up doing. Um, I definitely do think now is another buying opportunity. I've kind of just been levered, properly positioning myself this entire time, getting rid of shorter term contracts, opening 2028s instead of 2027s, just giving myself as much time as possible with leap contracts, keeping shares, selling managed covered calls as well, around that $35 to $40 strike range as well. Just keeping it honest. I'm just keeping it real. If the stock goes down, I make money on covered calls. If it goes up, I just keep on rolling. Especially when you're at this price range where, like, from a trailing 12-month basis, it's technically kind of more so on the fair value. But if you're going forward and looking at the growth, of course, there's a lot more room to run, which is very important to pay attention to. Um, Especially with Lucy and ICRAX. I'm glad you talked a little bit more about ICRAX and the EDE. It seems like ICRAX is more so like the data rails to actually run Lucy on to um, use that as the EDE to offer all the plans off of everything. So when you have all those plans on one platform and network, that offers a lot of opportunity, especially to have higher margin revenue. And I'm kind of wondering exactly how that would essentially work, if they're making more so money off of the employers and the employer cost to actually use the platform, or if they're getting a percentage of the fee that typically goes to a broker. Because these broker fees, I was able to get like a schedule of some of the fees that I found back from 2025, and they tend to be around $20 a month, $15 to $25 a month. I think maybe even $30 or $35 in certain states and areas. But when you're looking at a large portion of Oscar's members that go through brokers, that's a pretty decent chunk of money. I want to say, um, they said around like 75% of their members go through that, and when you're putting that, um, $20 per member per month fee on 75% of their members is around $45 million annually. So that's something to also consider as well, especially going into 2027, looking at fees, premiums, revenues. I'm sure there's a way to kind of backtrack their premiums, fees, and taxes inside of their SG&A expense to really kind of estimate the effect of those ACA premium fees being reduced in 2027 to really drive 2027 growth. Um, but yes, the future looks very, very bright. Short-term price action is going to be interesting, you know.
Yeah, I mean, we're up 108% year to date. We went down to 11. We ripped to what, 30? I don't think 32. I think we went high, didn't we? 33. Um, I'm not a crazy big buyer here. I already have a huge position, and if we get closer to 25-ish, then I would start buying again, small increments. Um, Future looks bright. I do believe they'll be able to execute and bring Lucy on market, which I think just brings massive gross margins to the table. The amount of the margins would just be insane with Lucy, because it's just this marketplace where all shoppers and all sellers of health insurance come to deliver and coexist. And if they're able to really hit this on the head with an administration that wants to see reform in the overall health insurance layout and get a free and fair market, which Mark Berlini obviously really wants. If you know him, he's literally pounding the table on it forever. Then Lucy would be huge. Like you could even run ads on the site. You can't, like, there's so many opportunities if they get Lucy right. If they don't, it's not a deal breaker. Lucy is a home run potential. ICRA is a home run potential. If you take those out and just consider what they're doing now with everything and where they are, I do believe they'll continue to grow over the years. I believe today the fair value is between $28 and $32. I believe if you're a forward-looking person, like most people are as investors, then your fair value is closer to 45 to 50 based on the next 3 years of outlook. But again, those are just numbers based on typical EPS earnings models, so on and so forth, right? So for this situation, saying they do $2 of EPS this year, they grow around 35% average EPS growth rate, give them their 5-year average of 16.4 target PE, do 3 years out, then you're looking around a $58 price, $77 3-year price, and you'll be a very happy shareholder in this company because they're going to give you 37% CAGR over the next 3 years. Yeah, I mean, overall earnings, I'm a very happy shareholder. What the price action does here, I know no one likes hearing this, but I honestly wouldn't mind them dipping back into that $25 area, getting a nice little reset, getting a nice little pullback, because it's healthy in a bull market. It's healthy in a bull run on any stock. So if that happens, I'll be a buyer. I don't think it stays down there long because, again, the fair value today sits around 28 to 32. So I would expect them to stay around there. But I also believe the next 2 quarters and for the rest of the year, unless they're able to really spin up hype and show Wall Street that ICRA is growing rapidly, Lucy is going to really be a big deal, then we might just see consolidation, pullback, run up, pullback, run up, consolidation, and just sit tight. I really like what AC said. It's if you were interested in selling covered calls, I think now is a pretty good time. Not today. You don't sell covered calls on a red day. But in general, where we're at with the stock price for the rest of the year, I don't think it's a bad idea to be selling covered calls because I don't really see outside of that September investor day anything crazy coming out that's like, oh, like there goes Oscar. Like this whole move has been basically because they came in and crushed Q1 earnings and shocked the street. So yeah, you just gotta remember, like, we've ran a lot. I'm not gonna be one of those guys where a stock runs a ton and like, it's still super undervalued if that's not the case. It's slightly undervalued right now, in my opinion, but it's not like crazy. Like Zeta, right? Like Zeta's 20 some bucks, and I believe it's a $40 stock. So
It's definitely going to be interesting to see what all the analysts say as well.
yeah, I mean, if they come out and upgrade too, then I think they're gonna, I don't know. I think they're just gonna be like happy with where they're at. Well, actually, there are still a lot of analysts that have like crazy low price targets, so they should all upgrade because they're just being silly at this point. But
Yeah, for sure. It's gonna be interesting. It's gonna be interesting to see for sure. I mean, I'm gonna continue doing my thing. You know, on the dips, just buying up my leaps, cover calls, doing that. I will say, the more I think about the earnings call, it was kind of interesting because when someone asked him a question revolving around 2027, he basically just said, "We're gonna go over like everything in the investor day," essentially. So it was almost kind of like I feel like he did it on purpose, but also just to not take up too much time. But also, it ended up the market didn't like that. So um, I will say that's probably also a factor to consider as well. It's at $7 billion market cap now.
Yep. 7.4.
That's crazy.
And market's kind of pushing down today now. Not SPY, but
Yeah,
the
I'm seeing a lot
Qs.
of red across the board. That doesn't help
Yeah.
at all.
Yeah,
Yeah,
over
I'm seeing
1%
almost
down on the
everything red.
Qs. So
Yeah, that also doesn't help as well.
yeah, again, I think
But
they did really well with earnings. I wouldn't expect. I think you're dead on with the move pre-market. Remember pre-market, there's lower volume, so algos can really throw around stocks like crazy. And I feel like with that big of a EPS beat, they probably shot this thing up and then cashed out on people. So who knows?
it,
Who really knows? But yeah. Did you catch the part where he talked about they're in talks with Mark Cuban for the prescription
yeah,
thing?
yeah. That was interesting too. I believe he mentioned that also on there was a podcast he did. He's done quite a few podcasts now, but there was one podcast where he was talking with Mark Cuban and working with Kroger as well. So that's going to be very interesting. And one thing that I'm just trying to wonder is if they're able to execute on this platform, like if they even get just one large employer, whether it be like a market basket in, you know, the northeast side of the US or just anywhere where they can like get them to utilize the platform and run an ICRA through their through through their health insurance for their employees, you know, that's going to be a huge amount of not only higher margin revenue, um, but also just growth in members. I believe I looked at Kroger, for example, like they have 400,000 members. Like if they were able to get even like a portion of that, even like a specific division of their employees, that would be huge. I will say, I do have to head out.
Yeah, I
It's
think
getting
it's
a
a
little
good
later.
spot to end it. Honestly, I mean, great earnings. They came in. They showed that hey, we are not just gonna be profitable one quarter. We're gonna be profitable back-to-back quarters, and we're gonna be profitable for this entire fiscal year, which is the biggest thing that matters. Um, if you're a shareholder, you should be happy with the results. I'm very happy to continue to hold this company. I still think that there's immense upside in Oscar. They're a $7 billion market cap company. I do believe they can grow into a 20, 30, 40, $50 billion market cap company. And you just got to sit there and understand that one quarter is one quarter, even though they crushed it. You got to just look at what they're doing, where they're going. And if you trust leadership, which I don't know how you don't trust Mark Bertolini at this point, because he literally took this company from a dying company to a thriving company, I'm a very happy shareholder. If honestly, me personally, um, I keep up with Oscar, but I trust the company so well now. Like I don't feel like I have to talk about it every day, or it's health insurance too, so it's not the most exciting thing to talk about. So I just been chilling, sitting on my shares. Like I said, I trimmed a little bit, but I'm really just chilling, and now I'm just trying to find new opportunities. Zeta's starting to run for me, so now I'm just kind of chilling with Zeta and taking that ride higher. I got into Palantir recently, on that last dip. Got into some other companies on that last dip. I'm chilling. I'm feeling great. I'm sure you're feeling great, AC. I mean, it was I really enjoyed owning Oscar when the rest of the market was tanking and Oscar was just ripping this entire year. So that's been really nice, and that's my portfolios are up significantly, 60, 70, 80% year to date. So I'm chilling like a villain. I can't complain. I'm happy.
Yep, 100%. I'm still 115% year to date, so
Killing
keeping it
it.
strong, keeping it
Killing
heavy Oscar. So,
it.
but I definitely think I've been kind of saying this like anytime anyone asks me like about my position, like just getting rid of shorter term contracts, buying 2028s instead, and just being in more shares because the higher the stock price goes, the less it's going to move. And, for 2027 contracts to move 100%, it's going to be more and more difficult. But 2028s, for example, that's a different story. 2028s have so much room to go, all things considered.
And the IV has
Um,
been very high. Everybody, when you're buying leaps, you really need to be conscious about the implied volatility percentage. When that's elevated like 60, 70, 80%, 90%, that's not the time to be buying leaps, guys. That is not the time to be buying leaps because when it's that high, you get this thing called IV crush. And so when the stock does move down, so when it does move against you, it is going to crush your options and your gains more so than if it goes up because higher IV means higher volatility, implied volatility. So that means if they're already expecting and pricing in that the stock is going to be all over the place and go on a huge run, then it's like betting on the favorite for a football game or a basketball game or something. You'll win if they win, but you'll win less, right? So just be aware of that. Hopefully this dip brings IV down and so on and so forth. But I know you got to go. I appreciate you coming on here, man. I appreciate you. Yeah, and what we've been able to do with Oscar. It's been great, great gains, and I'm excited for the future. We'll keep covering Oscar. We'll keep doing the earnings live. And yeah, hope you guys have a great and amazing day. Don't forget to like, don't forget to subscribe, don't forget to follow and like AC on X and YouTube as well, guys. Help him grow over there. He does amazing work, not just on Oscar, but a lot of other stocks like Zeta and SoFi as well. So appreciate you guys. Any closing remarks, AC?
That was a great quarter. Excited for the rest of 2026, 2027. And I think that the little bit of conservatism leaves a lot of room for the rest of the year, especially if favorability continues.
Couldn't agree more, man. Appreciate you coming on. Have a
Alrighty.
great rest of your day. Have a great day, guys. Catch you guys in the next one.